There are three things that traders need to make money in markets. They are volatility, volatility, and volatility. Without it, we can't make anything. This coming week has the potential to provide levels of volatility not seen since the COVID-19 pandemic of 2020 and the 2008 financial crisis. That's because there's a ticking time bomb at the heart of the financial system which could explode by Thursday this week, and that is the deadline for the US debt ceiling. Hello, I'm Nick Quinn, one of the trading coaches from ForexSignals and howtotrade.com, and this is your weekly preview for Monday, 29th of May, 2023. Your TLDR is that there's three key junctions in the coming week we need to be aware of. Month-end flows on Wednesday, non-farm payrolls on Friday, and whilst they'd usually be headline events all on their own, they will pale into insignificance on Thursday if the politicians in Washington fail to reach a deal and raise the $31.4 trillion debt ceiling to avoid a catastrophic default. Data-wise, Monday will be a write-off, so let's jump straight into Tuesday and look at the key markets to focus on this week.
So once the US come back from the Memorial Day bank holiday on Monday, everything should get back to normal on Tuesday. Overnight in Asia, I want to focus on the Japanese yen. We've got unemployment data from Japan being printed overnight as well. We're not expecting a change in that. 2.8 is what the market is looking for. But it does bring into question how the Japanese yen potentially might play a role in this week's debt ceiling negotiations because of its safe haven status. So you can see here on this daily time frame here, the levels we're currently sitting at as we go into the end of the week, this late 139 area, we've got this very beautiful looking AB equals CD harmonic structure now forming on the daily. Really nice big picture trade that gives us a PRZ zone here at this point D, potentially of the 141ish, something along those lines. So the way that then trades early in the week is going to be absolutely critical. I think we can get decent risk reward trades both directions on the Japanese yen. Overall, if I have to pick a direction for the yen at the moment, I would say that we're going to continue trending higher. Commercial hedging obviously agrees with that point of view as well, but nevertheless, any sort of problems with the debt ceiling negotiation, any weakness in the dollar, and any flow of funds into a safe haven status in the yen could definitely bring this 141 area into play, and we could see a decent move down, possibly even back down to this area of resistance around these 137 areas by the end of the week. Anything is possible. On Wednesday, we are expecting German inflation data just to continue pushing to the downside, but there's no questions there is potential problems on the horizon now for the German stock market. The DAX, as you can see here on this daily time frame, it is not looking particularly good. Now, given the fact that Germany now has moved into a technical recession as well, that puts potential extra pressure on risk assets in Germany. Expect some safe haven flows potentially moving into the bond and out of the German stock market. So if you look at the candles printing into the end of Friday, just bearish candle 1, 2, 3, 4, 5. It's not looking good. And we've just taken out this swing low here from the 11th of May. And if we sort of end the week below the 4th of May low as well, which comes in at 15,677, that's not looking good for next week. So I'd want to maintain a bearish stance on the DAX. You can see this this high here that we just tagged very nicely. A very strong rejection now over the last week or so. So where would we move from here if we're looking to trade to the downside? It has to be this area of support down here, starting at around about 15,286. That area all the way down to 14,996 as well will be the key area for me to focus on. Bear in mind that we have got a very nice looking doji here as well, printed on the 23rd of March as well. That is going to be an important inflection point as well, but I cannot see anything that's going to just give us upside potential. Any rallies that we get from here, it's got to be looking for a shorting opportunity. Any volatility from month-end flows on Wednesday will spill into the Thursday trading sessions if the US does not get any traction on these debt ceiling negotiations. It really is crunch time now. Going into the weekend at the time of recording, nothing is still been sorted. It's getting there, and we could actually end up moving into Thursday when everything has been resolved, which means that the markets will breathe a sigh of relief. But whatever happens, I would want to keep my eye on the S&P 500. You can see how compressed we are now in the price action. This green line down here that you can see, this is a daily time frame. That is the journey we've been on throughout the year. We've pretty much not gone anywhere on the S&P 500 yet, and we are looking for a meaningful break one way or the other. If the debt ceiling does not get raised, the US potentially defaults on its debt obligations, expect potential carnage to be in the markets and certainly on the stock market. We'd be looking to play that to the downside. I suspect you can see this broadening formation here that has been forming. That is showing us that the market is starting to thin out somewhat, potentially in preparation for that. If we get a meaningful relief rally, this is the area that I would want to focus on. 4,334, the top end of that resistance area. We've only tagged it once the summer last year, so we could get a potential move extension higher as a result of that if everything gets back to normal. If it doesn't, there are no rules on how we would play that. You'd be looking to play to the downside. Potentially we'd be looking at the start of the year where we're trading at 3,843 as a first port of call. From there, anything is possible. With that type of a scenario and situation, if you are uncertain, then don't be a hero. Stay out of the markets and just wait for the volatility to calm down. Bear in mind that margins will go up, spreads will widen. There could even be circuit breakers if it really does start to move in a very strong, volatile way as well. So just be careful if you are trading on Thursday. If we survive the volatility of Thursday, we've still got non-farm payrolls to contend with on Friday. The street is looking for 180,000 new jobs to be created in the US. That is a dovish print from the previous 253,000. Now, we are yet to see a meaningful impact on the jobs market from all of these interest rate hikes that we have had. I'm going to be focusing on the US dollar towards the end of the week, and you can see here on this daily time frame, that is a warning sign. The way that this is starting to build, it looks a little bit like a staircase. That's quite a crowded market at the moment on the dollar. Now, commercial hedgers don't have a huge amount of love for the long dollar trade at the moment, so I'm really starting to question the validity of this rally. From a momentum point of view, I cannot deny that the MACD is giving us a strong looking momentum background on the daily time frame, and if you look at the weekly as well, you can see we've had a decent cross at the beginning of May that has given us a good buy setup. But what it does do is it does just bring us into this top area here, this huge, great big support at the end of this support area here, 104.74 being the top end of that. We've already probed it once this year. So if we just go back down to the daily, you can see if we did get an expansion of volatility, which is highly possible on both sides of the market, it does bring into question this area of resistance here. We've already probed it twice. A break back into there would obviously open up the door for an extended rally up to 106.84. If that doesn't hold and then we get a move back to the downside, which is possible as well, you have to be looking at the lows of the year with the kind of volatility we could potentially get this week. That brings this 101 into 100 area into focus, and then an extended move if we get a break lower from there into this area of support here, starting at 99.42, moving all the way down to 97.53.
So there you have it. Non-farm payroll would usually be a highlight of the month, but this week there are no rules if the US debt ceiling is not raised. Rating agency Fitch has already put the US on watch, meaning they are at risk of losing their AAA status if a default did occur. Make no mistake, this week is about as serious as it gets. Whatever happens, Shane Vernier, Connor Woods and myself will guide you through the week every day in the trading room. We live stream throughout the day, so you'll have over 30 years trading knowledge and experience in your corner. Head over to howtotrade.com and sign up for a free trial today, and we'll see you in our next live stream.